I think the key, or one of the keys certainly, is that aviation stays. And there had been some expectation perhaps along the way, as we knew that the company was doing this very long review of its businesses led by Mr. Flannery and his board, that aviation perhaps could find itself outside of GE on its own because of course, the great value that that company conceivably would have were it to have been a reverse Morris Trust candidate or something like that. That's not the case. Healthcare is what is going to be sent out into the public markets. They will monetize 20% and split or spin the remaining 80% such that current shareholders will have the ownership of this new company. They do plan to maintain their current quarterly dividend at least through the completion of that healthcare separation. Again, as we said a few weeks ago, and as Mr. Flannery had alluded to in comments that were sort of somewhat misinterpreted when he presented at an investment conference a few weeks back. Then you're going to get that adjustment in the GE dividend. And of course, healthcare itself will pay a dividend commensurate with what is a typical payout ratio for companies like it. And just to put that in perspective, we're talking about the likes of Siemens or to a lesser but still extent Medtronic, Danaher, Thermo, Agilent. These are all within the peer group of what is an enormous company, $19 billion in revenues. They're hoping that it would be valued by the public markets at somewhere around 14 to 15 times EBITDA, which would give it an overall value of, let's call it, between 60 to 70 billion dollars. That would be worth upwards of $5 a share at this point. And just to give you a sense in terms of the value. And then you're going to have a healthcare company that has a different capital allocation strategy, perhaps more access to capital than it currently does. And it's going to return, it's going to take $18 billion in debt and pension liabilities with it as well. So much of this ends up being about the balance sheet, which has been a concern to GE shareholders. Remember, of course, one of the key lines, dividing lines for what this stock has suffered so much as a result of was when they took that hit on the long-term care liabilities as a part of still what is left of GE Capital, despite the fact that they've gotten rid of most of it. This will have the effect overall, they say, of reducing leverage by 2020 from what is 3.5 times to 2.5 times by 2020. They want to take an additional $500 million of costs out of the business by pushing down the cost centers from headquarters to the units themselves. And then you end up with power, renewables, and aviation, which are, in a way, kind of all make things that turn around.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.